All right, it's a great pleasure to have the opportunity to discuss this paper on improving US monetary policy communications. So what the paper does, it first has these interviews with about 24 former central bank officials, academics, and market economists about FOMC communications. And there they find that the most mentioned topics are reaction function of the central bank, talking about risk uncertainty, the infamous dot plot of the Fed, and using transparency as a tool. Now, based on these interviews and insights from the literature, the paper goes ahead by recommending improvements to the Fed's monetary policy communications, using three important principles. Trying to simplify public statements while still conveying the diversity of views, clarifying how monetary policy will react to changing circumstances, and highlighting monetary policy uncertainty and risks. Now, I fully agree with these principles, but of course the devil is in the detail and how exactly you're going to go and implement those. In that respect, the paper has very concrete proposals how to greatly simplify and modify the Federal Open Market Committee post-meeting statement. And it also looks at the summary of economic projections, which is currently only released after 3 weeks, together with the FOMC meeting minutes. And they propose to convert this into a concise report on economic projections that is released together with the chair's post-meeting press conference. And before going into this in more detail to review these concrete proposals, let's take a step back and see the significant improvements that the Fed has made in improving monetary policy transparency. As Steve has already indicated precise changes that have been made. I'd like to look at it using an index that has actually recently come out. It's published in a Oxford Handbook of Central Banking. And it's based on work that I've done together with Nurkis Dinser and Barry Eichengreen. It's building on previous work that we have done, developing an index for monetary policy transparency that assesses whether central banks disclose particular types of information that are pertinent to monetary policy making. And we see for the Fed that there has been a gradual improvement over time, looking back at the last 2 decades, corresponding to first always publishing a policy explanation, including the voting records with the meeting statement, publishing the minutes earlier, it's here, publishing quarterly medium-term projections and a summary of economic projections. And then we see this big jump up since 2012, when the Fed provided a statement clarifying its monetary policy framework and strategy, quantifying its main goals, and systematically providing quantitative forward guidance in the form of this dot plot. And with all these changes over time, the Fed currently, in 2015, ranks the score. When we compare that to other central banks, we have a sample of 112 central banks covering nearly 150 countries. And the Fed reached the third highest score of that sample. So the Fed has made significant improvements over time. But this doesn't tell you how influential these communications are. So to have a closer look at that, I refer to some work in progress with Simon Lloyd, who's at the Bank of England. And we look at the effect of communications on monetary policy anticipations, which we measure using changes in the overnight index swap rate, so OIS rates. And so here, for instance, we look at daily changes in the 1-month US OIS rate for about 16 years. And what we do is we look at how the change can be explained by monetary policy announcement, other communications, by running a regression and putting indicator variables for these communications in. We also control for macroeconomic data surprises. Then what we find is that more than a third of the variation in the daily changes of the 1-month OIS rate for the US can be explained by these US monetary policy announcements. Yeah. About 1/3 can be explained by FOMC speeches, And then very small role for congressional testimony, FOMC minutes, and macroeconomic data surprises. About 1/4 is unexplained. Now, this is for 1-month OIS rates. We can also look at other horizons. That's shown in the next picture. Now, the first bar here in this bar chart is representing exactly the same information we just saw in the pie chart. The other bars shown are showing what the decomposition is for longer horizons, up to 24 months. And we see as the horizon increases, then monetary policy announcements become less and less important in influencing monetary policy anticipations at these longer horizons, whereas speeches by FOMC participants become more and more important. We also see that the explained variation declines over time. So to allow for a comparison across different horizons and also across years, we normalize it by looking at what is the fraction as in terms of the explained variation. That's shown in this picture here. So what we show here is a decomposition that measures the relative importance of various types of Fed communications in explaining US monetary policy anticipations as measured by daily changes in OIS rates. Now, what we see here is the same picture as before, but now we've also looked more closely at the speeches and distinguished between speeches by the Fed chair, those by FOMC voters, and those of FOMC non-voters. And what we see is that in terms of the variation in OIS rates, the chair on his or her own has about as much impact as all the non-voting FOMC members together, reflecting the fact that the chair's speeches tend to have greater impact. Now, so this is for a long period of time, and there have been significant changes in Fed chairs. So let's have a look at Greenspan period first, when he was chair. We see now the picture looks very different. During the Greenspan, when he was chair, US monetary policy announcements did not affect monetary policy anticipations very much at all. Instead, it was mostly speeches by FOMC participants, and congressional testimony was quite influential, and at longer horizons also macroeconomic data surprises. Now let's move on to Bernanke. Looks completely different now. Now, at short horizons, the monetary policy announcement, and that includes the press conference, everything that is released on that day, are dominant in explaining changes in monetary policy anticipations. But in longer horizons, it's speeches by FOMC participants. Finally, it's Janet Yellen as chair, again, completely different. Now, speeches are dominant throughout, and what we see is an increased importance in speeches by non-voting FOMC members. So what this shows is that if you really want to improve Federal Reserve communications in terms of how they affect monetary policy anticipations, you really want to look at the speeches of FOMC members, because they are driving much of the variation in monetary policy anticipations. The present paper focuses on the statements, so let's have a look at what the proposal is there. So with respect to the statement, the proposal of the paper is to greatly simplify and modify the statement. I fully believe in making the statement accessible, but that's important for accountability. It should be readable to people in Congress. That's what the Fed is accountable to. But the paper suggests to go even further, to simplify it to such an extent that it will be readable by high school seniors. But there's a trade-off there. Simplification comes at a cost of precision. You provide less information, and as a result, you reduce transparency. I do not think that is desirable, because we have seen that the statements, especially during the Bernanke period that included the financial crisis, were very important in influencing monetary policy anticipations at short horizons. So you may not want to have statements that are less informative. Then the paper is proposing to provide an indication of the macroeconomic outlook, uncertainty, the balance of risk, and a brief discussion of alternative scenarios. I fully agree with that. I think that's a very good idea. There's too little of that in the current statement. However, when you look at the proposals that are concluded in the paper, so really rewriting the statements the way they like to see them, those alternatives actually provide very little explanation of the FOMC view on current economic conditions. But that is very important for understanding where they want to go. If there's been a drop in output, then you want to know, is this due to devastating effect of hurricanes, or is it due to the pernicious effect of protectionist trade policies? You'd like to know the FOMC's view on it, and that's not in the current proposal. Then they suggest to express the diversity of views and the reason for dissents briefly. I fully agree with that. However, what they do is they no longer focus on formulating a committee view. And I think that is problematic, especially if you want to go and have greater discipline in the communications by FOMC participants. Then they suggest to include decisions about changes in the size of the Fed's balance sheet. I fully agree with that, because large-scale asset purchases and unwinding are part of monetary policy, so they belong in a monetary policy statement. And it's frankly really strange that when the Fed decided to basically announce that it was going to stop unwinding, stop the quantitative tightening with respect to US Treasuries, that this was hidden in some other document. It was not featured in the main FOMC statement. I think that's a mistake. Quantitative easing, quantitative tightening are part of monetary policy. Any changes therein should be in a monetary policy announcement. But then the proposal, when you look at the way they phrased it, they've taken out any forward guidance that was in a policy statement about the policy rates. And I think that belongs in there because the Fed has provided useful qualitative forward guidance. The final change is that they are suggesting to use a flexible structure and phrases. I fully agree with that. I think the fact that the Fed tends to use a template with only small changes in words may be very nice for people who do algorithmic trading, but it is undesirable. So greater flexibility would be desired, with one exception, it is for forward guidance. There you want to be crystal clear whether you have a change in the signal or not. So for that, I would recommend using fixed phrases. So all in all, I think that the paper makes some very good proposals as to how to improve the current official FOMC statement. But I wouldn't go as far as they do by replacing the current FOMC statement. I would improve it and then release a separate, simplified, narrative-based statement that is aimed at media, including social media and the general public. There's no need to have just one statement. You can have different statements for different audiences. Of course, they got to be consistent. Then with respect to the publication of macroeconomic projections, this is useful because it reduces uncertainty about the macroeconomic outlook, and it improves understanding of shocks that are anticipated by policymakers. But the latter requires that you know the underlying policy path. Without it, you do not know whether any changes in projected variables are due to anticipated shocks or are due to policy. So it's vital that the underlying policy path is disclosed, no matter what it is, market expectations or the projected policy path. So what does the Fed do? FOMC projections are conditional on appropriate monetary policy. So they have the advantage that they are also informative about FOMC participants' reaction functions. But unfortunately, we do not know how all the dots link up and how they relate to the projection estimates. That information is only revealed after 5 years. And using medians across variables and years is problematic because they need not correspond to the same person. Then, so the Fed has these projections based on appropriate monetary policy, so they provide forward guidance. This serves two purposes. Time-dependent forward guidance helps to influence market expectations because you provide information about likely future policy rates. As a result, you're able to have greater control over longer-term yields that really matter for economic decisions. State-contingent guidance helps to understand monetary policy reaction functions and thereby improve medium-term predictability. What does the Fed do? Well, its dot plot is really about providing time-dependent guidance, but still leaves us with a cloud of uncertainty about future Fed policy, because we have no idea which of these dots correspond to voters and non-voters. So we cannot even identify the median voter from the dot plot. And since there are many different dots and we don't know how they line up with the projection estimates, they don't really help in interpreting the economic projections either. So there's clearly great scope for improvement here. So what does the paper propose in this respect? They suggest to release a short report on economic projections for the press conference, replacing the box-whisker plot of dispersion by fan charts that are based on historical forecast errors, including graphs of subjective uncertainty and balance of risk and a brief narrative of the outlook and risks. So my view on this is that I think it's very useful to put the focus more on forecast uncertainty than the dispersion of forecasts, because forecast dispersion is not representative of forecast uncertainty. And when you look at the box-whisker chart and you look at the fan based on forecast uncertainty, you see how different they are. Forecast uncertainty tends to increase over the horizon, and the dispersion actually tends to decrease as the horizon increases. But the problem with the proposed fan charts is that they are based on historical forecast errors, which are not informative about the current uncertainty faced about the outlook and the balance of risks. But they do suggest to include graphs on subjective uncertainty and the balance of risks. But the problem is, if they're not consistent with the fan chart, it can be very confusing. Then the paper's suggesting to release the matrix that links the estimates of variables. Now, as mentioned, that's very important to correctly interpret the projections and to estimate reaction functions. However, releasing an anonymous matrix does not allow you to identify the median voter. But even if you know all the individuals involved, then you still only know their views before they met and deliberated. So it's not necessarily that informative about the FOMC reaction function that follows after the deliberations. So my view on this is that it would, instead of like releasing this matrix and having even more emphasis on individual views with a zoo of 19 different reaction functions, my proposal is to actually change what the projections are about. Instead of making them conditional on appropriate monetary policy, make them conditional on the most likely monetary policy, so that they become more useful to communicate the committee view and will improve our understanding of the FOMC reaction function, and thereby improve our understanding of US monetary policy making. Thanks.